Hello, I'm here today to talk about capital gains taxes. Bear with me. I'm sure many of you know what these are. Simply, when you own a thing and end up selling that thing for more than you bought it for, you make a profit. That profit is known as a capital gain, and that gain is something the government like to tax. So, whether it's a valuable painting, stocks and shares, or a house, if you sell something you've owned for more than you bought it for, the government tax that profit you make from doing so. Except here's the catch. If the house is where you live, i.e. your primary residence, you will not pay capital gains tax. Why? Perhaps on the surface this is a fair exception to the rule. You live there. However, I believe this exemption is a much bigger deal than people realise. Let me illustrate. Bob has a job, whereas Simona homeowner has a house. She might have a job too, but let's not worry about that. We're just interested in her home ownership. Bob's job earns him the average London salary of £38,000. The home Simona homeowner owns is worth the average London house price, £480,000. So, let's also look at historic house price growth to date. Since 1990, 20 years' worth of house price growth has, on average, amounted to an increase of 9% a year. Applying this 9% to her house price going forward, that amounts to an annual untaxed gain of £44,000. Incidentally, this gain itself will actually grow at 9% too in subsequent years, but let's not get distracted by compound growth. Instead, let's just focus on the £44,000 for the year in question. Now, as I've told you, this gain is not taxed, not least because it is only a notional increase in personal wealth. Simona homeowner still lives in the same home, and nothing really seems to have changed. But, more importantly, it is tax-free regardless, even if this gain is technically cashed in. But we'll come on to that later. By contrast, Bob's 38 grand income, earned in exchange for his work and productive contribution to the economy and society, is taxed by the government. Once the UK government have taken their £8,000, he is left with £30,000. That is £14,000 less than Simone's untaxed 44 grand gain, earned in exchange for Simona homeowners' home ownership alone. That there is the heart of the issue. Productively earned income is taxed and amounts to less than these untaxed and unearned gains in wealth. In fact, because you pay proportionately more income tax when your salary is bigger, Bob would actually have to earn a £61,000 pre-tax salary before after tax he is matching the 44 grand discussed. And for reference, a £61,000 pre-tax salary is in fact a 95th percentile salary in the UK. That is, only 5% of the population earn above this level of income. Now, this is of course a deliberately simplistic example to emphasise the dynamic at play here. Perhaps you wish to point out to me that homeowners are paying mortgages, for example. Fine, let's consider that Simona homeowner could well be paying a mortgage. Bob is not paying a mortgage, but, therefore, instead is likely paying monthly rent. Renting has been more expensive than paying off a mortgage in the last 10 years, a clear advantage to Simona homeowner. But this simple case above is deliberately ignoring all living costs and is only concerned with comparing Bob's total annual income to Simona homeowner's annual capital gain. Indeed, Simona homeowner more than likely does have a job and an income, on top of her capital gain. She may even have other sources of income. Perhaps some extra income even comes from tenants, Bob's, who pay rent to her, a homeowner. By definition, this transfer of income can only ever go in this direction, from Bob's to Simone's. All these extra advantages are perhaps more obvious. It is no secret whatsoever that homeowners have a clear and significant financial advantage over non-homeowners. My point comes before all these extra considerations and advantages. All living costs aside, Bob's post-tax income is £14,000 less than Simona homeowner's annual capital gain. Bob, in exchange for a year of his hard work, makes £14,000 less than Simona homeowner makes from her homeownership alone. This, to me, is why it is so commonly referred to as the property ladder. This £14,000 is absolutely everything. It essentially tells us that getting onto the housing ladder is the be-all and end-all. Once you own a home, even if you also work, say earning the average salary just as Bob does, you will therein make much more money from the price of your property increasing than you will make from every remaining working day of your career. That surely has to change. An individual's financial opportunities should not hinge so significantly upon whether or not they own a home. Given all its clear advantages, a place on this ladder, I would argue, should not be accompanied by such extraordinary tax relief. At the very least, it should be taxed according to the same rules as any other assets that generate capital returns. With this huge tax break afforded to just the homeowning part of society, let's take an extreme example to illustrate the dynamic. Now we have Simona homeowner, Jerome a homeowner, and Joan a homeowner. Each person bought an identical home for a tidy sum of £50,000, but years later they now all fancy moving. Simone likes Jerome's home, Jerome likes Joan's home, and Joan likes Simone's home. All three parties are in agreement. Their houses are now each worth £250,000, and that's fine, because they can sell their respective properties to the interested party and use the proceeds to purchase the house they want. In the process, they have all just added a cool 200 grand to their total personal wealth, tax-free. Now, there is some tax paid on the transaction, stamp duty, and that is charged as a percent of the total value of the property. In this case, it will amount to around £1,000 being paid to the government by each of our homeowners. But that is a small price to pay for ultimately being 200 grand better off. Now, as we know, today this 200 grand capital gain is completely tax-free. But, let's say, instead of stamp duty, capital gains are taxed at the standard 20% rate. This would amount to a 40 grand tax bill, potentially less depending on capital gains allowances. Nonetheless, here you would question whether Simone, Jerome and Joan have the same incentive to overvalue their properties upon selling to one another. If they all sell to one another at the original £50,000 they each paid before, they avoid paying any tax as there is no chargeable gain on the transaction. Instead, the current stamp duty system in the UK penalises the transaction. If you move 3 times in 3 years, you pay 3 lots of stamp duty bills. Is that fair? Freedom to move and relocate should be encouraged and would make the labour market more flexible. That can only be a good thing. Tax the unearned gain in wealth, not the transaction. So yes, all in all, the discussion may sound fueled by jealousy, or you could think this is aggressive, toxic socialism. On the contrary, this is not a debate on whether society should pay more or less tax. Instead, it takes the need to collect some tax as a given and focuses instead on what should be taxed. Taxing income that is earned by people working and productively contributing to an economy, and not taxing wealth gains on property that are earned in exchange for zero economic contribution, distorts incentives within society. It is correct to say that wealth is stored income, so has already been taxed as it was earned. But any unearned gains to that wealth, to the tune of several %100% in the case of UK property, should be taxed in line with any other assets that a person owns.